What if the very foundation of global finance, the US dollar, is beginning to crack, exposing a fatal flaw in the supersized bubble propping up the entire world economy? For decades, it has been the undisputed king of currencies, but this year, the dollar has dropped 10%, its worst annual performance since 1973. You might not notice it at the grocery store or in your paycheck just yet, but the consequences are massive. A weakening dollar ripples through every corner of the economy, from housing to stocks to global trade, and the deeper this decline goes, the more serious the risk becomes for every financial asset in the months ahead. Now, a 10% drop might not sound catastrophic, but when we're talking about the dollar index, which measures the US dollar against other major currencies, it's record-breaking in all the wrong ways. Let's put this into perspective through international eyes. The US has always been a magnet for global capital. Investors from Europe, Asia, and beyond put money into American markets because of strong returns. But when the dollar weakens this much, those returns get wiped out. Take the S&P 500. Year to date, it's up 14%. A fantastic result on paper, but here's the catch. For a European investor, the euro has gained almost the same 14% against the dollar. That means when they convert back to their currency and essentially cash out, their return isn't 14%, it's basically zero. Think about that. While US investors celebrate a boom, international investors are breaking even. And when money managers overseas realize they can get the same return without the currency risk, they start pulling money out of America and putting it elsewhere. That shift drains investment from US markets, amplifying the cracks already forming in the system. And here's where it gets even worse. The weak dollar isn't just punishing foreign investors in the US, it's also pulling American money overseas. Yes, the S&P 500 is up 14% this year, which sounds fantastic, but look at Europe. Broad national indexes are posting eye-popping gains. Take Spain, for example, the EWP, which is basically Spain's S&P 500 equivalent, tracking a wide swath of Spanish equities. That index is up 60% year to date. And remember, that's not one speculative stock, that's essentially an entire country's stock market surging. So why are there such huge returns for Americans investing abroad? Well, because the currency effect works in reverse. When the dollar weakens, US investors holding foreign assets see their returns amplified as those currencies strengthen. So while European investors get burned converting back into euros, Americans in Europe are cashing in. The German index is up 31% this year for US investors. Italy's equivalent up 46%. That kind of performance makes the S&P's 14% look weak by comparison, and it creates a powerful incentive for US capital to flow out of American markets and into Europe. Now you might be thinking, okay, that's interesting, but how does any of this actually affect me here in the US? After all, the stock market still looks like it's booming, and on the surface, the economy doesn't seem to be flashing red. Well, the problem is what a record-breaking weak dollar does under the hood. Economists estimate that for every 10% drop in the dollar, inflation rises by about 30 basis points. In plain English, as the dollar loses value, everything we import from oil to electronics to food gets more expensive. And when you add tariffs on top of that, the pressure only intensifies. Now combine those forces with the Federal Reserve openly talking about more rate cuts this year, and the risk becomes obvious. Instead of inflation cooling, we could be on the verge of it flaring right back up. And you're already seeing this shift play out in gold. In 2025, gold is having one of its best years ever. Prices per ounce are up roughly 46%. That kind of move isn't random, it's a red flag. Gold often acts like a barometer for weak currencies and inflation rising underneath the surface. When people no longer trust the dollar, they move into something with real value. If gold is going vertical, it's telling us the financial system senses deeper stress, and it's betting the dollar is going to weaken even further. And hanging over all of this is the fear of stagflation, the nightmare scenario of rising prices colliding with a slowing economy. Think of it as inflation paired with a recession, a double hit that's historically been one of the toughest environments for both investors and policymakers. While official CPI numbers remain within a normal range, there are growing concerns based on real-world reports. For example, Walmart has explicitly stated that prices continue to rise as inventory is replenished in the post-tariff environment, and that further increases are expected in Q3. Even by official CPI standards, inflation is creeping higher, raising fears of a second wave. What makes the current environment unusual is the behavior of the dollar. Typically, during equity market declines, the dollar strengthens as a safe haven asset. In April, following the tariff shock that drove the S&P 500 down nearly 19%, the recovery itself was not surprising. Markets have bounced back after nearly every correction since 2012. The anomaly was that the dollar weakened during the sell-off and continued to fall even as equities rebounded. Looking back at the last 15 major corrections since the early 2000s, the dollar index historically rises by an average of around 10% when the S&P 500 falls. Such a divergence suggests that the dollar may no longer be viewed as the reliable safe haven it once was. Instead, markets could be signaling deeper concerns about inflation, US economic stability, and the dollar's long-term role. And that brings us to the big question. If stagflation, inflation, and weakening currencies really are the direction we're headed, where do you put your money? Because here's the truth, moments like these always create opportunities, and one of the clearest signals we're already seeing is in distressed real estate. Foreclosures are on the rise again, and that's where today's sponsor, Foreclosure.com, comes in. Foreclosure.com is the nation's #1 resource for distressed properties with over 1.8 million listings covering foreclosures, pre-foreclosures, tax liens, bankruptcies, and government-owned homes. What makes them different? Their data updates 24/7, so unlike other sites, you're not wasting your time on stale or already sold listings. You're seeing fresh opportunities in real time. You can search by zip code, state, or even on a map, and you'll find detailed property info, tax roll data, photos, and even local school districts. For investors, that means you can buy at a discount, flip for a profit, or hold for long-term rental income. For home buyers, it's a way to finally find something affordable in today's impossible market. And here's the kicker, you don't have to risk anything to try it. Foreclosure.com is offering a free 7-day trial, no obligation. Just sign up, explore the listings, and see for yourself. If you cancel before the 7 days are up, it costs you nothing. If you keep it, it's only $39.80 a month, basically $9.95 a week. I've dropped my link in both the description and pinned comment. If you're even a little curious about what's out there, check it out now and start searching, because while the headlines scream recession, the smart money is already hunting deals, and Foreclosure.com is the best place to find them. At the end of the day, this isn't just about the dollar dropping or gold spiking. It's about a shift in confidence, a signal that the world may no longer see the US dollar as untouchable. And if that's true, the ripple effects could be bigger than anyone expects, from housing to markets to the entire global financial system. The real question is, are we witnessing the early cracks of something much larger, or is this just another cycle in disguise? Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and make sure you leave a comment below letting me know what you think of these new currency developments.